The world's largest oil reserves are now ground zero for a financial earthquake. Venezuela's 303 billion barrels could trigger a global currency collapse. Imagine your living costs spiking overnight. This isn't just about oil. It's about the dollar's very survival. A rumor sent shockwaves through global finance. Venezuela was poised to price its crude in a BRICS currency basket. This threatened to unravel the petrodollar system. Could this really bring the debt-driven Western economy down like a house of cards? But here's the real story unfolding behind the headlines. This isn't just about geopolitical posturing. It's a calculated financial maneuver with massive implications for your money. Beneath the official statements, deeper motives are at play. The U.S. aims to control Venezuela's vast oil supply. This isn't solely for energy security. It's a direct strategy to stimulate global demand for the dollar. Access to these immense reserves helps the U.S. cement its status as a dominant crude producer. It also provides a vital geostrategic advantage over rivals. We're talking about 300 billion barrels, remember? That's 17% of global stock. This aggressive play directly targets the petrodollar system. Since the 1970s, major oil producers priced their crude in dollars. This made the greenback the primary currency for oil trade. It created unceasing demand for the dollar worldwide. This system has been losing some of its luster lately. Other currencies are gaining ground in oil trade. Protecting the petrodollar maintains Washington's economic and strategic might. The motivations run even deeper. Beyond just controlling oil, the U.S. also seeks to cut off Cuba's primary energy lifeline. This is a significant strategic priority. More critically for global finance, it's about protecting the dollar-based petrodollar from existential threats. Venezuela's past sales of oil to China, settled in yuan, were a red flag. This showed the dollar system was optional. However, there's a huge catch for this oil quest. Without a democratic transition, the long-term investment needed just won't happen. Political instability is the enemy of capital. Sidelining legitimate opposition, like Maria Corina Machado, makes things worse. It undermines the very stability required for oil production recovery. Experts warn this could derail the entire plan. The Trump administration's plan includes a specific provision. Proceeds from Venezuelan oil sales must settle in U.S.-controlled bank accounts. These funds are then dispersed at U.S. discretion. This isn't liberation, it's about securing collateral. It's about maintaining dollar dominance by force. What happens if this financial power grab backfires? Welcome to Empire Finance. We cover economics, finance, and the latest news. Subscribe for daily, well-researched videos that go deeper than the headlines. Now, to truly understand this aggressive play, we need to rewind the clock. The dollar's unique power isn't just happenstance. Its global dominance was deliberately engineered. This started decades ago. Think back to 1971. President Nixon cut the dollar's link to gold. This move created a fiat currency. It was backed only by faith. To maintain its value, Washington struck a monumental deal. This happened in 1974. They negotiated with Saudi Arabia. This agreement had two key parts. The U.S. offered military protection for Saudi oil fields. In return, the kingdom agreed to price all its oil exports exclusively in dollars. Saudi Arabia also pledged to invest its massive oil revenue surpluses back into the U.S. financial system. This arrangement became the petrodollar system. It forced oil-importing nations worldwide to constantly buy dollars. This created unceasing demand for the greenback. It significantly boosted Washington's economic and strategic might. This system made oil a potent financial weapon. All modern economies need oil. They need it to power factories, heat homes, and fuel transportation. Oil, under U.S. control or its allies, became a crucial choke point. It allows U.S. officials to exert leverage. They can plunge economies into chaos by cutting off oil access. We've seen this tactic used repeatedly. Look at Iran in 1953, or Iraq in 2003, Libya in 2011, Russia in 2022, Syria in 2024, and now Venezuela in 2026. The consistent factor is America's use of the world's oil trade as a tool of financial control. This strategy aims for unipolar control over global trade and dollarized financial arrangements. The U.S. seeks to block countries from withdrawing from its economic sphere. It wants to frustrate the rise of a Eurasian-centered economic grouping. This is called a civilizational war by strategists. It's a fight for economic systems, This power to coerce is almost the only tool left for the U.S. economy. It has deindustrialized significantly. It faces massive foreign debt. This situation now threatens the dollar's dominant monetary role. Think about that. Historically, money itself was a choke point after World War II. The U.S. Treasury held 80% of the world's monetary gold by 1947. U.S. diplomats used the IMF and World Bank. They imposed pro-U.S. privatization policies, pushed regressive taxation. They opened foreign economies to U.S. investors. This all became part of the dollarized international trade system. Today, oil serves a similar purpose. U.S. officials want world trade and raw materials priced in dollars. They also want oil and other export surpluses invested in the United States. This is the, quote, give back President Trump has pursued. But the petrodollar system has been losing its luster. Emerging economies like China challenge its dominance. U.S. sanctions on major oil producers like Iran and Russia also play a part. These sanctioned countries often trade oil in other currencies. This chips away at dollar demand. The U.S. shift to a net oil exporter also changes its position. It potentially reduces its dependence on this very system it created. Venezuela's actions directly challenge this long-standing control. Supplying 5% of China's oil needs, for instance, undermines U.S. leverage. Venezuela also supplied Iran and Cuba. These oil exports are not under U.S. control. This weakens Washington's ability to use energy as a weapon. It lessens the squeeze on other economies. It prevents the U.S. from threatening withdrawal of energy. Germany's deindustrialization after its Russian oil and gas trade was blocked is a stark example of this leverage. The U.S. demanded this sacrifice from its allies. It aimed to hurt Russian and Chinese economies. It also generated LNG export revenues for itself. This highlights an overarching feature of U.S. national security policy. It's the power to block other countries. It prevents them from acting in their own economic interests. This asymmetry was built into the world economy. It began after World War II. Back then, the U.S. offered immense economic support. Today, American power to coerce is mainly backed by threats. These threats cause injury and chaos. They exploit choke points. They even involve bombing weaker countries. This is to force compliance. This destructive leverage is the only policy tool remaining. For investors, this presents a complex picture. The dollar's strength has long relied on these choke points. But the world is changing. Other nations are actively seeking alternatives. They are building new economic alliances. This raises a critical question for investors. How long can this coercive strategy sustain the dollar's dominance? What are the long-term financial risks of relying on threats instead of positive inducements in a multipolar world? Now, wait till you hear this. The stakes in Venezuela are even higher than they appear. This is not just about oil. It is a full-blown tactical war for the dollar's very survival. Think about it. A direct attack on the BRICS bloc. This group of nations, including major oil powers, actively seeks alternatives to the dollar. For the United States, losing the dollar means losing World War III. This is not hyperbole. It is a deeply held strategic view. Remember the petrodollar system? It is gasping. The dollar is backed not by gold, but by oil's dollar pricing since 1971. In 2024, Saudi Arabia decided not to renew its exclusive petrodollar treaty. This news largely went unnoticed, yet it was lethal for the American economy. The dollar's exorbitant privilege has been leaking away. Then came Washington's red line, a rumor spread through global finance. Venezuela, home to the world's largest oil reserves, was preparing to price its crude. It would use a BRICS currency basket. Washington could not allow this to happen. If Venezuela severed ties with the dollar, the consequences would be dire. Demand for U.S. bonds could collapse. Interest rates would spike to historic highs. This would cause the West's debt-driven economy to fall. It would collapse like a house of cards. Imagine that. Here is the deeper truth for everyday Americans. If Venezuela sold its oil in yuan, China would not need U.S. dollars. If China then sold its vast dollar holdings, the dollar's value would plummet. Your living costs would spike overnight. That is the real threat. This isn't just about Venezuela. Trump's actions are part of a broader campaign. He is waging war against the BRICS nations. They are building new financial systems. They are creating alternatives to the dollar. This includes Brazil, a key pillar of the bloc. Nigeria, a recent BRICS member, is also a target. Cuba, seeking refuge in BRICS, faces threats. Iran remains under constant pressure. Trump even announced a 25% tariff on any country doing business with Iran. Even Mexico is implicated. It is the largest oil supplier to Cuba. This means choking Cuba would require dealing with Mexico. Threats against drug cartels could be a pretext. They could create greater geopolitical pressure on Mexico's government. This is a race against time for Trump. Polls favor Democrats for the midterm elections. A Senate measure prohibits military adventures without congressional consent. He may have only 10 months to execute his regional control agenda. The media called the Venezuela operation a democratic victory. They called it a tactical masterpiece. But it was a glittering circus. It was designed to keep our eyes fixed on the clowns, not on the vault behind the tent. This was a margin call. It was an emergency summons from a breathless economic system. Caracas was an attempt to plug the dam with force. Chevron and Exxon were summoned. Contracts were rewritten. Barrels were chained back to dollars at gunpoint. Stability, they said. Coercion, the dictionary replies. For investors, these are seismic shifts. The dollar's global status is under direct assault. The potential for collapsing U.S. bond demand is real. Spiking interest rates would ripple through every portfolio. Major oil companies have even warned Trump. Political instability is the enemy of capital. This shows internal U.S. disagreement. You can seize oil for a year or two. You cannot seize the future. History might record Caracas differently, perhaps not as the apex of power, more like an admission of bankruptcy. The glass broken, the lever pulled. So how do you prepare for a world where the dollar faces its greatest challenge yet? What does this mean for your long-term financial security? Now, here's the real twist. This isn't just about seizing oil. It reveals a profound shift in American foreign policy. President Trump's actions in Venezuela reflect a new strategic blueprint. It is called the Monroe Doctrine. This reinterprets the 200-year-old Monroe Doctrine. The 2025 National Security Strategy laid out this plan. It elevates the Western Hemisphere to a central position. China is seen as a strategic threat, not just a trade rival. The strategy aims to control ports, infrastructure, and supply chains. It also targets strategic resources. Latin America is now a security perimeter and economic asset. Washington wants to be the partner of first choice. It discourages collaboration with others. This involves incentives and pressure. Migration and drug trafficking are now national security threats. This justifies military interventions. The threshold for intervention has significantly lowered. The focus isn't just on having oil. It's about what kind of oil it is. Venezuela boasts 303 billion barrels. This is the world's largest proven crude oil reserve. It represents about 20% of global totals. This even surpasses Saudi Arabia's reserves. But there is a catch. Venezuelan crude is predominantly heavy and high in sulfur. This requires specialized refining infrastructure. It also needs significant diluent mixing. Years of underinvestment have crippled its infrastructure. Production capacity is currently 900,000 barrels per day. Historically, it was over 3 million barrels per day. Recovering this capacity is a massive undertaking. It demands an estimated $100 billion in capital. This is one of the largest potential energy investments globally. Major oil companies like ExxonMobil are wary. Previous asset seizures create huge investment barriers. They demand fundamental legal changes. This highlights the substantial financial risk. The country also faces workforce expertise gaps. Over 500,000 oil workers left from 2010 to 2020. Environmental remediation costs are also unknown. These are serious operational challenges. For investors, this creates a deep instability trap. The operation in Caracas removed Maduro. Yet the underlying kleptocratic regime remains in place. The popular democratic opposition is no closer to power. Oil revenues now flow into U.S.-controlled escrow accounts. This might seem like control. But seizing oil without a democratic foundation is fragile. It ensures long-term political instability. This instability creates immense risks for foreign investments. Trump's Venezuelan oil quest will ultimately fail without democracy. A deal imposed by force lacks legitimacy. This impacts future investment certainty. Investors need stable legal and commercial frameworks. Without them, capital won't flow freely. The cost of doing business becomes astronomical. This coercive strategy might secure oil today, but it jeopardizes its long-term viability. It makes the investment extremely risky. So what does this mean for your portfolio? The geopolitical landscape is shifting dramatically. The U.S. is redefining its global strategy. It uses military and economic coercion. This creates both opportunities and immense risks. Venezuela's specific oil challenges add another layer of complexity. The long-term stability of these secured assets is questionable. Can a strategy built on force truly guarantee investment returns? Or will it lead to an endless cycle of instability, eroding investor confidence and capital over time? Now, let's bring this home. What does this seismic shift mean for your money? The implications of a weakening petrodollar are not abstract theories. They are already knocking on your financial door. Consider this specific development. In 2024, Saudi Arabia opted not to renew its exclusive petrodollar treaty with the U.S. This quiet decision, largely overlooked, was called lethal for the American economy. It signals a tangible erosion of the dollar's global dominance. And there's the Venezuela situation. The rumor that froze global finance was this: Venezuela, holding the planet's largest oil reserves, planned to price its crude against a BRICS currency basket. This was a red line for Washington. If Venezuela sold oil in yuan, China would need fewer dollars. If China then sold its dollars, the dollar's value could plummet. This isn't just about global power plays. It hits your wallet directly. If the dollar falls, your purchasing power drops. The cost of imported goods, like food and medicine, could skyrocket overnight. Your family budget would face immense pressure. Furthermore, a declining dollar could trigger a banking and credit crisis. To retain capital, interest rates could soar to historic highs. Imagine your mortgage, auto loan, or business loan becoming suddenly unaffordable. This ripple effect impacts every aspect of your financial life. So, what can you do as an investor? First, recognize that the war against the BRICS is a tactical fight for the dollar's survival. This geopolitical tension directly influences market dynamics. Commodities, for example, often become volatile during such periods. Protecting your portfolio requires a strategic approach. Look beyond solely dollar-denominated assets. Consider diversifying into other stable currencies or tangible commodities. Gold, for instance, has historically served as a hedge against currency devaluation. Explore investments in emerging markets that are part of the BRICS bloc. As global economic power shifts, these regions may offer new opportunities. Diversification is key to navigating this changing landscape. Your goal is to build resilience. Think about assets that hold value regardless of the dollar's fluctuations. Are you prepared for a world where your dollar buys less? Now let's connect all the dots. This isn't simply about oil. It's about maintaining the dollar's global power. The 1974 deal with Saudi Arabia set the stage. The U.S. offered military protection. In return, Saudi Arabia priced oil in dollars. They also invested surpluses in U.S. financial systems. This created constant demand for the dollar. Today, the U.S. leverages oil control as a key foreign policy tool. It coerces nations when traditional economic incentives are scarce. This destructive power is a primary instrument. Trump's actions directly challenge OPEC's market influence. Their revenue targets, like Saudi Arabia's $70 to $75 break-even, face immense pressure. America's production surge, including potential Venezuelan recovery, amplifies this. It shifts market dynamics for savvy investors. Understanding these power plays is critical for your portfolio. It impacts global energy prices and investment stability. Don't get caught off guard. Subscribe for more deep dives into finance and geopolitics. How will this ongoing struggle shape your financial future?